Good day. This is our discussions for foreign currency transactions or accounting for foreign currency transactions, also known as Forex transactions. So Forex is same as foreign currency, or Forex is the shortened version of foreign currency. All right. So allow me to show to you the PDF file of accounting for foreign currency transactions from Guerrero's book. Now, it is normal for a company to really grow and such would enter into imports and exports. So purchase of goods from abroad and sale of goods to other countries, which are called imports and exports respectively. So the company really is experiencing growth that it expanded or expands its operations worldwide because also of like less stringent or less strict, for example, regulations and tariffs for globalization and internationalization, and safety protocols have been in place for the participants, or let's just say friendly mechanisms are there in the market. So that's why more businesses are involved in such. And this is also the reason why there would be two accounting problems that would be resulting from growth in world trade and foreign operations. So the first one is the accounting problems related to foreign currency transactions, which will give rise to receivables and payables denominated in foreign currencies. So if we say foreign currency transactions, of course, one of the requirements is that the transaction is stated or denominated in foreign currency. But then they must be measured and recorded in the Philippine currency or peso. So this could be the first item that we must take note. And then the second one is, what if there would be foreign currency operations? So meaning to say we have our branches from other countries, and then we are now going to consolidate or combine our financial statements as a whole. But then the financial statements should be stated into Philippine currencies or currency because, well, let's just say that the mother or the main branch or company or the mother headquarter or headquarters, we would say, is in the Philippines. So meaning it is a Philippine-based corporation, just like, for example, JFC, Jollibee Foods Corporation, wherein we have seen already the dramatic growth in that it has already expanded to a lot of countries worldwide. But remember that the mother is in the Philippines, therefore there's a need for us to translate the financial statements from those foreign operations in other countries into Philippine IFRSs and the currencies also. So this would be the concerns that we are going to deal with. Now for this chapter, this would be for number one, the transactions that we are going to look into. Now, for our discussions, we are going to refer to IAS number 21, accounting for the effects of changes in foreign exchange rates. But then for this one, this would be for PFRS 9 because this has been superseded already. So PFRS 9, financial instrument recognition and measurement. Next, measured versus denominated. Now, if you say measured, this is really the value that we see as the amount of a transaction, while denominated is the value in which that is expressed in a certain currency. Now, for measured, though, in this situation, it must be measured for financial reporting purposes in another currency, while denominated is the value that is stated. All right. So, for example, let's say there is a purchase transaction, and then it is stated in United States dollars, but then because the company here is based in the Philippines that entered into the purchase or import transaction, so it should be measured in Philippine pesos. And that's why denominated versus measured would not be the same. They would be the same if we're talking about transactions that happened in the same country or transactions that involve entities of same country or geographic region. So in that case, denominated or measured would be the same. Let's say two Philippine-based companies. So again, the two terms would be similar. In that, for example, for a foreign currency transaction to be really one, it should be denominated in that particular currency that is a foreign currency and to be settled, either to be collected or paid in that same currency. All right, so I repeat, a foreign currency transaction is a transaction that is both denominated and to be settled either collected or paid in that same currency. So for example, again, purchase transaction, we bought goods on credit from US dollars. It is a foreign currency transaction if, for example, it is denominated and expressed in United States dollars to be settled in United States dollars. So it should be both denominated. In other words, if it's stated in Philippine pesos and then to be paid in, for example, other currency, that's not a foreign currency transaction. Or let's just say it is, of course, both. If both Philippine pesos denominated and to be settled Philippine pesos, clearly that's a Philippine-based transaction, not a foreign currency transaction. Or if it is stated in US dollars but to be paid in Philippine pesos, that's not a foreign currency transaction. But then where's the measure there? It would come after the transaction has happened. Wherein we have to really translate that, or we have to convert that into Philippine pesos. Now I use the term conversion and translation, but this will be subdivided and differentiated later on. If we say conversion, this means actually the process of changing or calculating the equivalent amount or value of Philippine pesos, for example, into US dollars or vice versa at certain point in time. So normally we have like exchange rates for currencies on a daily basis. So if we do such, that's called conversion if we talk about transactions. But if we talk about financial statements, so the proper term is translation. So we would be saying then that transactions are converted from Philippine pesos, for example, to US dollars, or let's just say because our country is Philippine pesos, so from US dollars to Philippine pesos, and then financial statements are translated from US dollars to Philippine pesos and not the reverse. In this chapter, of course, because in real life, we can, of course, interchange the terms. But in business world, we might be very particular with the terms though. Next, currency exchange rate is the rate by which two currencies are exchanged at a particular time. As said, this can happen on a daily basis, so we can see this on the business channel or on a newspaper. For example, $1 is how much in Philippine pesos. Now, there might be some quotes that would be shown to us on the given newspaper or television. So it can be a direct quotation or indirect quotation. If you say direct quotation, it is one foreign currency equals blank local currency. So our local currency here is clearly Philippine pesos. Our foreign currency is US dollar. So if that is one foreign currency or FC equals blank LC, that's a direct quotation. So assuming that we are in the Philippines. And then the indirect quotation is the reverse. So 1 LC equals blank FC because US dollars actually have higher values than pesos. So that's why the direct quotation would be showing that one foreign currency unit is equal to more units of the local currency. So that shows the direct quotation, and that shows that one currency has higher value than the other. So can you just imagine like $1 is equivalent to 56.20 pesos. So that means the dollar is powerful in that sense or more powerful. And then if it is the reverse, we actually can see here that 1 peso is just a fraction of the dollar. So this is like 0.01779, and that is indirect quotation. We can take note though that the two exchange rates are reciprocals of each other, of course. So 1 over 56.2 is this amount or value. So hopefully the two types of quotations are clear now. Next, there are also rates to consider. The rates could be selling or buying. Now, if we are on the part of the entity that is to sell certain currencies, for example, a bank that would be selling its currencies to the public, so it has its own selling spot rate. The banks buying spot rate is normally or usually less than the selling spot rate. Of course, when the bank bought those currencies, they will have to charge less so that they can have gross profit or gross margin on top of it to be able to earn in the process, and so that the selling spot rate is higher than the buying spot rate. Of course, this is business, everyone. So it is normal that when you buy it, it would be low or it low. That's what I've said, like a contraction to it would. Then for the selling spot rate, that's going to be higher. So sales is higher than cost of sales. This would be the cost. This would be the selling price. The difference of the two is called the spread or the gross profit of the trader in a foreign currency. All right. So these are the rates that could be the classification of those currency exchange rates if we talk about like what transactions that we are talking about. Are we selling? Are we buying? And then this is also one area that banks would actually earn in the process. Next would be other sets of rates called forward exchange rates. Actually, forward exchange rates are the rates by which the privately contracting parties would enter into. So example, let's say I want to purchase goods from abroad and then I don't have foreign currencies. So I would go to a bank so that I can buy foreign currencies. So in that case, the rates that would be related to the contract in terms of the foreign currencies would be the forward exchange rates. It is called a forward rate because the transaction, which is the import, happened, for example, at this time, but the payment will be done in a future time so that the exchange rate will be forwarded to that future date, hence the term forward. So the rates there are called forward exchange rates, and the contract is called, or contracts are called forward exchange contracts, which would be derivative instruments to be discussed later on in the chapter. Anyhow, so these are also rates, which can be selling or buying, depending on the transaction. Are we selling or buying? Another one is futures exchange rate or rates, which are the opposites of forward. If forward is done by privately contracting parties like a company and a bank, futures contracts actually are done in an established active market. For example, there are really trade markets for foreign currencies, and there's an established market for that. So if we enter contracts with such, and we, for example, base our rates on those futures exchange rates in such markets, then of course, we will call the contract as futures contract or futures exchange contract or contracts, and the rates are futures exchange rates. I may be going around the bush just to emphasize the point. All right, so those are for the rates. Now, for accounting for foreign currency transactions, as what I've said a while ago, they are transactions that are stated or denominated in foreign currencies and to be settled either to be collected if, for example, sales, or paid if payables, purchases in the same currency. So again, a purchase transaction of machinery from abroad in US dollars to be paid in US dollars in a future time, or sale of goods to a certain company from abroad or US, for example, in United States dollars and to be collected in United States dollars. So These are foreign currency transactions. However, again, because we are living in the Philippines, that's why these foreign currencies are to be converted. Remember the term converted versus translated, or conversion versus translation. So this is on the part of converted. Transactions, values, or amounts are to be converted into local currency units. All right. So here are some of the more common foreign currency transactions. So number one, we have to import and export goods on credit with a receivable or payable denominated in foreign currency. This is the sample that I've explained a while ago. Or we can borrow or lend money in foreign currency and to be settled in foreign currency, or we can enter into forward exchange contracts to buy or sell foreign currency, which will be discussed later on. So these are the three examples, common ones in this particular chapter. However, they may not be like the exclusive list, a said some. So there could be more that we will meet, if not in this course, but in the future time. Right, so import and exporting, or export of goods. So we have to take note though that in recording of transactions for accounting for foreign currency transactions, that there are three important dates. Although these dates actually have been recalled or can be translated or can be related to our discussions even from accounting one. So remember, the date of transaction is the time that we entered into the purchase. Then if it's going to be a long term or even short term but would extend the next year, so we would go on and beyond the balance sheet date, also known as reporting date. And then the settlement date will be, for example, next year. So these are the three dates that we have to take note. The transaction date, or the contract date, in which the contract has been perfected. And this is the time that we are going to record the accounting elements involved. So to record a value, that is simply going to be the number of foreign currency units, or the units, multiplied by the rate of that particular date. So you call this rate as the spot rate. The spot rate is basically the market prevailing rate for the currencies. Then number two is the balance sheet date, which is now known as reporting date. So I may use the two terms interchangeably as we discuss. This is the date that happens between the transaction or contract date and the settlement date, which can be settlement date, can be collection date, or payment date. And I may use the terms interchangeably also to discuss the items. Now, for the balance sheet date or reporting date, this is the time that we have to recognize any gain or loss because of the increase of the values of the transactions. And then we must also take note that no gain or loss will be recognized here, only at the balance sheet date and at the settlement date. The foreign exchange gain or loss is simply the difference between the movement of the rates multiplied by the same number of currencies. So example, if this is 5-year and this is 5.10, so there is a 0.10 difference. And then whether it is a gain or loss will be known later on. But clearly that's just the difference of the two rates. And then we do not recognize gain or loss that often. If you can notice, it is the transaction date and the balance sheet date or reporting date. And then at the settlement date, this is the time that we are going to now collect or pay the receivables and payables respectively. And this would also result to gain or loss because it's possible that the rate from number 2 is not the same as number 3. So still movements of rates. That's why we have to analyze the problems carefully because it's possible that, let's say, the transaction date is March, but then it would be settled by September. And then the year for the company is calendar year, which ends at December 31. Therefore, no intervening date or no date that is the reporting or balance sheet date. Intervening date is this date wherein we have to recognize gain or loss. So meaning, if it is within the same year and would not go beyond the reporting date, there is no gain or loss here. So only gain or loss on the settlement date. So I hope that is clear also because there are some problems like such. Here, importing transactions. So here's an example wherein the company purchased merchandise from a firm, and then there's a letter of credit from BPI, and here are the given items. So you have the date of arrival, balance sheet date, and the date of receipt of the documents, and the payment now for the said importation. Now, we have to take note that when we enter into these transactions, they are to be done bank to bank. So they have, of course, to undergo, for example, here, letter of credit with the bank so that the company can buy currencies from the bank, and then the money will be transferred from the bank to a US firm. So it's a matter of a bank to bank transfer. So that's why we will be looking into items here involving banks. Then also, this is how banks would earn. So they are going to charge from this importation, and they're also going to earn from the currencies, aside from the traditional bank service charges and interest from the loans that we have discussed. Then also, we have to take note that in this particular type of transaction, like the purchase of goods on account, there is a liability when the goods have been delivered to us. Normally, that's the system or the setup. And then, although we have known from our accounting standards that it is when substantial risks and rewards of ownership have been transferred or management control has been relinquished substantially to us, and that we are going to recognize revenue under IFRS 15 provisions also. But anyway, to simplify the problem, because the problem is straightforward, so it is when the goods have arrived or delivered to us. So to journalize, this is for the bank service charges. This is for the purchases at the spot rate on the date of arrival. So that's number of currency units times the rate. Purchases, credit acceptance payable. Probably the company used this account title because this is with a letter of credit, so acceptance payable. Although I would say accounts payable is okay. Then December 31, there is a movement here. If you are going to get the difference, that's 0.3. 0.3 times $10,000 is $3,000. There is a loss because this means that when the rate higher or becomes higher, then there is an additional liability on the part of the company. So there is additional payable. And because there is additional payable, the company loses in the process. And then later on, the company will pay more. So there's really a loss. By December 31, it increased further by zero point 0.1. So that's why 0.1 times 10,000 is 1,000. And that's still a loss because we have to pay more. 10,000 times 50.9 pesos, 509,000. And we have to close the accounts payable balance prior, which is 505,000 plus 3,000, right? So that's how simple it is to record the said transactions. Next, what about if there is a marginal deposit on letter of credit? It's possible that the bank would be requiring us to finance the said letter of credit and importation of a certain percentage. So let's say out of the $10,000, so in thousands, 10 in thousands dollars, letter of credit is 25%. So we are going to pay that to BPI. The we here is the Manila Corporation, of course, the business. And then $10,000, let's check. Okay, it's really the value or the amount here in the purchase contract. Then to continue, we have $10,000 times 50 pesos times 25%. This is the marginal deposit on LC. This is like a prepayment if you are going to think about it because we paid in advance for the transaction. And then on the date of settlement, this marginal deposit is applied as payment. How? So here, if this is like the situation now, so we are going to credit here marginal deposit on LC for 125,000 and the balance will be on cash. That's how it is because this is like a prepayment again. Probably the purpose of this one is for the protection of both parties so that Manila Corporation would really proceed to the transaction. And if it would not, so at least the company can perhaps deduct a portion of this amount and return whatever is left after deducting the charges to Manila Corporation. So at least BPI would not be on a losing end. All right. Next, what about on the perspectives though? So there are some debates as to what perspective that we are going to use. Is it two transaction or one transaction? So this is like a question that is asked by certain practitioners in the field. In one transaction perspective, there wouldn't be a balance sheet date or reporting date. So it will be contract or transaction date and the settlement date. So those two only. On a two transaction perspective, it should be that there is a reporting date and then there is a settlement date. So if this is like a one transaction perspective, so it would be, remember the value here, let's check, is 505,000. So this would be an X, meaning if we close this later on, this would be 4,000 loss and this would be acceptance payable of 505,000 as shown here. But then the author supports, even me would really support the two transaction perspective. It's because it encapsulates the point of IAS 21, which is the effects of changes in foreign exchange rates, since we incorporate it at the balance sheet date or reporting date, and we incorporate the changes of values. In fact, that's going to be okay because we just have to recognize it at just the reporting date than on a daily basis. Because if this is like a regular trading, it's going to be really on a daily basis if we think of movements of the rates or even in seconds and minutes in real life. But it is just summarized like one at the reporting date. So that's why we are going to use the two transaction perspective as shown in the problem. Hopefully that's clear. Then what about for an export transaction? Actually, the steps would be the same, except that we think now of the opposites. We're now on the part of the seller. So we think of the sales, of the receivables, then the purchases and payables. By the way, guys, if we bought asset, so we are going to debit that to the asset account, not the purchases. Here, this is merchandise. So this is for sale. That's why we are going to debit purchases. I hope that is also clear because that's going to spell difference perhaps later on in terms of parties. Then for another thing, it's going to be now the opposite. If we think that when the rate would increase, there is additional liability and therefore that's going to be a loss on the part of import transactions. However, for the export transactions, we think of the opposite. So this means that when the rates would increase, there would be additional receivables and there would be gain in the process because the company would be collecting more, right? And then these are the rates which are increasing. So let's check as to what I've said. Now, the company, of course, received a confirmation of LC from the bank of the US firm to support the purchase order. So if you can notice a while ago when we did the purchase or import transaction, we made or we entered into a letter of credit contract so that we can finance and the bank also will help us to support to finance our import transaction with charges, of course. Now, what if there's the opposite of marginal deposit of LC? There's really a packing credit line. So the LC is financed through the bank, but from the US firm who will be, or that will be purchasing our products, and then we received such in the representation of the BPI, our authorized agency bank. So we received the money cash, packing credit line at 100,000 pesos. Then we have the accounts receivable sales at the spot rate of the date of shipment. So take note, when the goods really are shipped by us to our customers, let's say this is FOB shipping point. So of course, at the point of shipment, it's now for the company or for the buyer. So that's why we have to recognize sales. Of course, we have to follow the provisions that we have learned from accounting subjects and from IFRS 15, revenue from contracts with customers. So accounts receivable sales, 506,000, both debit and credit. So unit times the rate. And then there's a gain, as what I've said, because there's zero point 0.2 difference. So we have to account for that. And this is zero point 0.1 difference. So that's going to be a gain of zero point 0.1 times 10,000, that's 1,000. And then the rate is 50.9 times how many units? That's $10,000. So that's 509,000 and accounts receivable. Now, remember there is like a packing credit line with BPI to fund the exportation against the confirmed purchase order or letter of credit. So in that case, the company will have like, of course, a liability in this case. So cash packing credit line of 100,000. And then it seemed in this problem that it is not closed. This one is not closed here as a debit so that the cash that would be received would be the difference. So it seemed that the company entered into a transaction that is separate from the receipt of the collection coming from the US firm or company. So this is also okay. We don't have to really close this one. So this is perhaps part of the negotiation again between Filipino company and BPI. Right. So that's it for import and export transactions. Now, what about if ever we talk about loans payable and loans receivable? If this is a loan payable, it's going to be the same again, except that we now think that there would be interest that would be employed. And remember, interest is a function of time. Interest equals principal times rate times time. Principal is the balance or whatever value there is on the note. If that is like compounded or just a straight or simple interest that is computed. And so in that case, of course, we have to follow the discussions from mathematics of investment for interest that's beyond our scope. But then interest is simply principal times rate times time. So this means that at the end of the reporting period or balance sheet date, there would be a certain interest that would be earned or that would be incurred. And in that sense, there wouldn't be exchange gain or loss yet on the interest because interest is just computed on that date. The gain or loss will be attributed only on the principal amount or value. But at the settlement date, if that is going to go beyond the reporting date, so there would be a gain or loss both on the principal and interest. So this is one thing that students or learners would miss sometimes if we talk about loans payable and loans receivable. So we can notice here that this is purchases accounts payable at 580,000 and just one day we converted the liability into notes payable, which is one way of settling it. If you can notice by June 30, the interest expense is just whatever is the rate, 5.88 prevailing, times the 100,000 times, that's the, of course, principal, the rate for the exchange is 5.88 times time, which is, this is like assumed to be 30 days though, right? Anyhow, so 30 days, and then could be like 30, well, 30 minus 30 from May 30. So 30 days, then the rate is 12%. All right. So that's how we got or we get 5,880 as the interest, of course, expense. Well, the gain or loss is, if you can notice, 5.88 as the rate minus 5.80 is 0.08 times 100,000 units is 8,000. There is no yet loss attributable to the interest because this is like the contract date. Although May 30 is really the contract or transaction date, then this is the conversion of liability to another liability. So we can like refer to this one. This is the contract date, so 30 days from May 30 to June 30. And then no loss yet on the interest, but for the principal there is. That's 0.08 difference times 100,000 and that's 8,000. The note payable is the principal and then the cash is, of course, 101,000, that's 100,000 principal, interest 1,000 times 5.88. So that's how we got for June 30. On another hand or situation though, for loan receivable in the illustration, although it is not stated in the problem, and also we just have to think of the opposite. If this is like loan receivable denominated in foreign currency, it is because we are now on the part of the seller, and then we think again of the sales and the receivables. So to begin, this is May 31. Let's just say this is 31, and then this is the transaction or contract date. So the date of perfection. The contract is good for 60 days with 12% interest, and this is the exchange rate for 1 yen. That's equivalent to 0.43 pesos. So just a tangent though question for this one, we can ask ourselves, which is then the powerful one? Is it the peso or the yen? So we might be asking about that then or though. So to answer that question, so this means that the peso is more powerful compared or as compared with the yen. When I said, by the way, more powerful, I'm talking about currency wise. I'm not talking about any other things. Just a disclaimer though for the discussions. So yeah, which is more powerful? It will be the peso. If we're going to analyze, 1 yen is just a fraction, 0.43 of a peso. If you are going to convert this one, like we are going to get the reciprocal, so 1 divided by 0.43, so that 1 peso will be equivalent to certain number of whole number of the pesos. So of course, we can actually compute that if you are holding your calculators. We can view this actually as direct quotation because this is a foreign currency. One foreign currency equals blank local currency, our Philippine peso. So 1 yen is just a fraction of our peso. If we convert this to the indirect quotations, you will be getting that 1 peso is 2 point something, 2.32 or 33, rounded off. So 2.33 of the yen. So this means that it takes 2.33 yen to match 1 peso. So peso indeed is more powerful than yen in this situation. So just a tangent point of view about this one. So if this is accounting though, we just have to follow whatever is the rate. So that's how simple it is. But that could be a financial management perspective under multinational financial management. All right. So for April 30, this is going to be, if you can notice, interest income is already earned in the process. So there is 1 million times 12% times 30 over 360. And then that's 4,500. And the interest income is 4,500. And then the Forex gain is again just related to the principal, not yet or not involving the interest. And then for May 30, if you can notice, of course, there is already the recognition of Forex loss, including the interest. Of course, this is the settlement date. And then, or this is the collection date for the loans receivable. And then we close the interest receivable from here, recognize the interest income based on the updated rate, 0.44 times 12% times 30 days from April 30 to May 30 over 360. So for computation of interest, remember, we use the actual days, but business year or business number of days composed of 360 days. And the cash should be the principal plus the interest, total interest, then multiplied by the prevailing rate. All right. So those are the inputs for loans receivable. This could be tricky as compared to import transactions alone. Now to summarize for foreign exchange gains and losses, although I've said already in that, well, for the impact, whether there will be gains and losses if selling spot rates would increase or whatnot, that's going to be a matter of which transaction that we are talking about. Is that involving a receivable or does that involve a payable? And although we have said that selling spot rate here is highlighted, however, we have to take note, guys, that if the transaction is import or buying a loan payable or any transaction involving payables, we have to use the selling spot rate because this means that for us to be able to pay our liability, we need to buy foreign currencies. Where do we buy foreign currencies? From the banks, and the banks would be charging their selling spot rate. So that's why import buying transactions is to selling spot rates. On the other hand, if you think of, for example, the receivables, the sales, we are going to use the buying spot rates. Why? When we will be receiving our respective collections out of the sales in the form of foreign currencies, we'll be depositing them to the banks. And the banks would be, of course, treating them as if they're buying them. And then they will be recognizing a liability out of the buying foreign currency rates, not the selling ones. So that's why sales transactions, export receivables is to buying spot rates. And then to summarize for the gains and losses, we can notice here that for import, if the exchange rate would really increase, there's really a loss because that would result to additional payable. If the receivable, that would be a gain because we need or we will be collecting more. If there is a decrease in the rate, so this means that there would be a decrease of the payable, so that's going to be a gain, but we will be collecting less out of the receivables, so that would be a loss on the other hand, right? And then we are guided by IAS 21 again. So this ends part one of our discussions for accounting for foreign currency transactions. Hopefully you learned something from this session and I'll see you next time for another video. Thank you and God bless us all.